Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, good morning, everyone. So first, the announcement about next Monday's lecture, because this lecture theater will be used for other purpose. So our Monday's lecture is rearranged, rescheduled to Thursday. Okay, so in my memory, I think it's from Thursday from 1 p.m. to 3 p.m. I'll double check. They'll make a proper announcement on Voto, okay? So next week's lecture is all about revision. I'll go through some questions with you guys, do our final round of revision, and next week, we don't have workshop, okay? Next week, we don't have a workshop. This week, we still have workshop running on Thursday. All right, so that's the first announcement. And then remember to go to your allocated tutorial for your last quiz, quiz number 6, okay? So quiz 6 is based on previous week's material. Okay, so this week we're going to talk about some other derivatives, weather derivatives, CDS, credit default swap, and we're going to talk about energy derivatives, and then finally we're going to talk about some mishaps in financial markets. Okay, so as we discussed last week, some of the exotic option does serve a purpose, right? So they serve a purpose for people who would like to hedge, whereas some other type of exotic options that it seems like they're designed for purely speculation purpose. So for example, why do I want an option written on an option? So today we are going to look at some other types of derivative, and they are very useful in real life. So this derivative contract help us to manage risk, manage credit risk, manage energy price risk, and the weather risk. Okay. So I'm not sure whether everyone is familiar with the notion of credit risk. So basically, if you have, lend money to somebody, and what you expect getting in return is the interest payment plus the principal, okay? And obviously, you are exposed to credit risk. So better the company's credit rating, more likely they will like to repay the money back to you. And, if they have better credit rating, and more likely you're going to charge a lower rate of interest. So worse counterparty's credit rating, and less likely you'll get your money back, so you would like to charge a higher interest rate, just to bear that extra credit risk you are exposed to. And likewise, we're going to talk about some of the weather derivative as well. Okay, so for example, you could operate a business which thrives in winter season, and for example, selling winter clothes. What if there is an unseasonable warm winter? Then that would obviously affect your business. And we're going to talk about how are we going to use weather derivatives to help us to manage that sort of risk. Okay, then we talk about some insurance derivative. So for those who are doing actuarial studies, you would either have done a little bit about this, or you will do a lot more of this in your future course. So we're going to look at an idea called reinsurance. Okay, so when you're insured with company like Westpac or Commonwealth Bank, they don't actually bear the full risk. Okay, so they sell the insurance premium to you, and which in turn they sell it to some global insurance company for the reinsurance purpose. And then we're going to introduce a special bond called CAT bond, catastrophic bond. So basically, insurance company can issue the CAT bond to help them to reinsure without selling their insurance premium to another reinsurance company. And then lastly, we're going to talk about some stories about the derivative mishap in financial markets. Okay? So that's the plan for today's lecture. So first of all, we're going to talk about the credit derivatives. So these are the ones the derivative help you to protect against a credit event. So protect against the chance that you will not get your principal and interest back from your investments. And there are three main types of them. So the first one we're going to talk about is credit default swaps. Then the second type is total return swap. So we kind of touched on total return swaps last week. And then we're going to talk about something called credit spread options. So let's think about credit default swap, how credit default swap work. So for example, a company like General Motors. So General Motors is an automobile company that produces cars in the United States, right? So General Motors has a very mature business, right? So everybody recognizes their brand, and they have a stable production, they have stable sales. So for those type of company, they prefer to issue corporate bonds in the corporate bond market to raise money, instead of taking out loans from their banks. Okay? And as an investor, so for example me, I would like to buy General Motors corporate bonds. Okay? So General Motors has a credit rating of AAA rated. AAA rated credit rating means they have very good credit history, but that doesn't mean their bond is riskless. They still have some risk, okay? So General Motors issued corporate bond still subject to risk because General Motors can default, right? So if you think about the threat from electrical cars that's threatening the traditional automobile industry, so General Motors still exposed to risk, and there's a chance that General Motors can default. And as a corporate bond holder, I bought the bonds from the General Motors. How can I protect myself against a default event? So that's where the credit default swap come into play, okay? So usually insurance company and banks, they sell the credit default swap. So the way it works is that I'm an investor and I bought the corporate bonds from General Motors. Then at the same time, I would buy a CDS, credit default swap, from a bank. Okay, so the bank sells the CDS to me, so the bank is the CDS seller, and I'm the CDS buyer. All right, so usually the CDS is a contract. All right, so it specifies that if a technical default took place, for example, if General Motors missed out a coupon, then that can be classified as a technical default. If that technical default happens, then the seller of the CDS will compensate me, okay? So the bank who sold me that CDS will provide me a payoff, right, to compensate me for the fact that the General Motors defaulted on its corporate bonds. Okay, so why CDS is in such high popularity? So because, for example, if you think about the corporate bond holders is not like banks. When the bank lend money to company like General Motors, they usually require a large collateral, okay? And the bank are usually secured debtors. So when General Motors defaults, secured debtors would get the first payment from the residual value of the company, right? So imagine if the General Motors defaults, the regular process is that the court would decide, okay, so let's liquidate General Motors. So they would sell all of the assets of General Motors, and that's called the residual value from the General Motors. And that money would first distribute to secured debtors, right, secured creditors. So the bank are usually ranked on the top, so the bank gets all the money paid. Then the remaining money goes to the unsecured debtors, for example, corporate bond holders, right? So in other words, corporate bond holders may not get much from the General Motors liquidation. And that's where the CDS came in handy, okay? So in return, the CDS seller, for example, in our example, is the bank who sold me the CDS, they will get a portion of interest payment from me, from the bondholder. So for example, I need to pay the bank certain interest payment every 6 months. Usually it's specified as a percentage of the face value of General Motors corporate bond. Okay, so if you like, you can think about this money I paid to the bank serve as an insurance premium. And as I mentioned before, if General Motors had a technical default, for example, if the General Motors missed out on its coupon, or General Motors cannot roll over their debt, so that's called a technical default, then I will get a payoff from the bank. So the payoff come into two forms. So the first payoff form is called physical settlements. So with the physical settlements is I can sell this troubled bond to the bank who sold me the CDS, and then I can sell this troubled bond to the bank for the face value upon this credit event occurs, okay? And the seller of the CDS, which is the bank, is obligated to buy this troubled bond from me for the face value. So the first method is called the physical settlements. We're going to go through the detail about physical settlements again in an example. And the second method is called the cash settlement, okay? So the way how cash settlement works is that in the case of a default, organization, so this organization called International Swaps and a Derivative Association will organize an auction, okay? So this auction is used to determine the value of the cheapest delivery bond after the occurrence of default. Okay, so for example, the General Motors bond probably have a face value, for example, $100. And after the auction, this organization, International Swap and a Derivative Association, would determine that this bond can be sold for $25 per $100 face value. In other words, as the bondholder, I can still recover 25% from this troubled bonds, okay? If that's the case, then the seller of the CDS, which is the bank, need to compensate me the remaining amounts, which is 75% of the notional principal, okay? So let me say this again, with the cash settlements, usually there's an auction. So the auction is to determine what's the market value of this troubled bonds, right? Because the General Motors has defaulted. Now, once they determine how much I can recover from selling this troubled bonds, then the bank will compensate me the remaining amounts of the face value. So if the bond I can recover 25% from this troubled bonds, then the bank needs to compensate me the remaining 75%. So that's how CDS works. So with the CDS market, there was a very active market before the financial crisis. And during the financial crisis, you couldn't really buy any CDS because no one is willing to sell them because the risk was so high at the time. So that's all you need to know about CDS. It's really just an insurance premium, okay? And the useful part about having an active CDS market is that as an investor, I can look up what's the CDS spread trading on General Motors to get a feeling of how much the credit risk the General Motors are currently having. Basically, I'm just checking what other investors think how risky is General Motors. And then I can use the CDS spread to do other pricing stuff. So I can use the CDS spread maybe for the pricing of General Motors bank loan. So the CDS spread has that purpose. Basically, it reveals information to other type of investors. Okay, so that's basically what I said, the mechanics how CDS works. Now let's have a look at this particular example here. So that's basically the physical settlements and cash settlements I just talked about. So with the cash settlements, usually there is auction to determine what's the Q. So Q, you can think about the Q is how much you can recover from these bonds, right? Then the seller of the CDS need to compensate you 100 minus Q percentage of the notional principal. Basically, that's the remaining part of the notional principal. That's how much the seller of the CDS need to compensate you after the auction. Okay, so here is one example. The example says, two parties entered into a 5-year CDS on 1st March, year 2000. The notional principal is 100 million, and the buyer of the CDS agreed to pay 90 basis points annually for the protection against the default by the reference entity. So what is the reference entity? So the reference entity in our example is General Motors. It's the company who issued the corporate bond. Okay, then the question says, if the reference entity does not default, then the buyer of the CDS, which is me, so the buyer of the CDS usually is the corporate bondholder, receives no payoff from the bank, okay? And instead, I need to pay the bank $900,000 each year, on the 1st of March for year 2001, 2002, and afterwards until year 2005. Okay? So that was the question. And then the example says, suppose that the reference entity defaulted on 1st September year 2003, which is halfway through the 4th year. If the contract specifies the physical settlement, then what happens? Then if the contract specifies the cash settlement, then what happens? Okay, so let's go back to this example here. There's a couple of things I would like to mention is that the payment, so as the buyer of the CDS, when we pay this 90 basis points to the seller of the CDS, we pay this $900,000 each year in arrears, which is, there's 1 year lag in terms of the payments. So how do I get this 900,000? That's 90 basis points times the notional principal, which is 100 million. So that's 900,000. That's how much I need to pay to the seller of the CDS. But that payment is made in arrears each year. Okay? And if you read the question carefully, it says the reference entity defaulted on 1st September year 2003, right? And our CDS contract starts with 1st of March, which means that's half year through the 4th year, right? So that's the half year through the 4th year, which means by the time of default, we still owe $450,000 to the seller of the CDS. That money hasn't been paid. Why? Because $900,000 is paid in arrears, okay? And the default happened halfway through, which means before we get our payoff from the seller of the CDS, we still need to pay that $450,000, which is 900,000 divided by 2, right? So the $450,000 covers the half year through the 4th year, okay? So that's the first thing we need to do. We need to pay $450,000 to the seller of the CDS. Then, as I mentioned earlier, there are 2 ways this CDS can be settled. So the first one is by physical settlement. Basically, with the physical settlement, we simply sell this troubled bond to the seller of the CDS for its face value. And the seller is obligated to buy this bond from us, okay? So in our example here, it specifies that the buyer of the CDS has the right to sell this 100 million par value to the seller. So the seller have to pay us $100 million as a compensation. So that's the physical settlement. Now, the second way this CDS contract can be settled is through the cash settlements. So in the example of the cash settlements, someone would organize an auction. So they use this auction to determine the recovery value of this troubled bond, okay? And in this particular question, we were told we can recover $35 per $100. In other words, the recovery rate is 35%. So we can recover 35% of the par value from the auction. And then the seller of the CDS need to compensate us the remaining 65% of the notional principal. So how much is that? So 65% times 100 million notional principal, the seller of the CDS need to pay us $65 million for the cash settlements. Okay? So before the seller of the CDS make those settlements to you, first of all, you need to pay $450,000 the accrued interest to the seller because the default happened halfway through. Okay? Does this example make sense? Basically, you just need to remember how physical settlement works. Yes? Yes, sounds like put option. When the value is lower than a certain level, then the company defaults. Then if that happens, then you get a payoff, yes. But for this course, you don't need to know how to value the CDS, all right? but you need to be able to explain how it works, explain the mechanics behind the CDS, right? So for example, you can get a question like this. So give you a situation and ask you how much you still owe to the seller of the CDS. And the question could ask you, what if this CDS is through the cash settlement? How much you can get in return? So you need to be able to answer those, but you don't need to be able to know how to price this stuff. So any other question with CDS contract? Okay, so that's the CDS contract. Then the second type of credit derivatives we're going to talk about is the total return swap. Okay, we kind of mentioned about total return swap a little bit in last week's lecture. So I'm going to give you guys a simple example. Just imagine we have a bank which predominantly lend money to one particular industry. That's actually how it works in real life, because there's a lot of commercial banks that specialize in lending money to certain industries, okay? Because there's fixed costs for banks to acquire knowledge about that particular industry. For example, if I'm a bank who specializes lending money to the airline industry, then obviously over past decades, I've learned a lot about airline company, and I know how to kind of assess airline company's risk, and I know how much collateral I should ask from the airline company, and I know how much money I can lend to the airline company. And some other commercial bank which specialize in lending money to oil company, right? So over the years, they would accumulate a lot of knowledge about the oil, about how the oil price moves through time. And for those companies, they are reluctant to switch to other industry for lending money to, because if that's the case, they need to spend more time and energy to learn more knowledge about that particular industry. So how can I diversify their risk, right? If I only lend money to the airline company, so all of my credit risk is highly correlated with the performance of airline industry. Now, the easiest way for those banks to diversify their credit risk is by using this total return swap, right? So for instance, as I mentioned in the example, we have the bank who predominantly lends money to the airline company, and then we have another kind of commercial bank who specializes in lending money to the oil company. Now imagine if there's a downturn in the airline company, the airline company don't make as much money as they used to. You know, oil price goes up and the wages goes up. That lowers the airline company's earnings, okay? So that's kind of credit risk to the bank. So if you think about the airline company, the biggest expenditure to them is the aviation fuel, right? So if that's the case, then you're happy to swap some of your loan book with the commercial bank who specialized in oil industry, okay? So basically, you can set up a total return swap. So if the airline company lends $20 billion to the airline company, and the oil company lends $20 billion to the oil company, then they would put in place a total swap. So basically, the way how total swap works is very similar to the interest rate swap we did in week 3. So remember, in week 3, what we did is we have fixed interest rate payments swapped with the variable interest rate payments, right? So the fixed rate payment and the variable payments going back and forth. Now, but this time, what they're swapping is the payment on their loan book. Okay, so essentially, the bank wants to diversify their loan portfolio without spending too much time and energy to specialize in another industry which is outside of their comfort zone. So for example, the airline company would like to swap 50% of its interest and principal payments that they received from the airline company with 50% of the interest and payments from the oil bank, which is in turn received from the oil company. Okay, so by doing so, you'll get the diversification benefits. So you are not so exposed to the industry risk, the industry that you are specialized in. And then we also have a bank acting as an intermediary in the middle, right? They would charge a commission to set up this swap. All right, so do you know do you need to know how to value this sort of swap? No, you don't need to know how to value this sort of swap. All right, so Do you know how to draw the diagram to design a total return swap? No, not for this course. So all you need to know about this is, again, you need to know the mechanics behind the total return swap. You need to be able to illustrate in words how it works. And yeah, so that's pretty much all you need to know about total return swap. So any questions about total return swap? All right, then we're going to look at another type of the credit derivative, which is called credit spread option. Okay, so for people who wanted the credit spread option, is that if you're worried about you only invest in one particular asset, if other assets perform really well, then basically you missed out on those high returns, right? So there's an opportunity cost there. But imagine there were two assets, and imagine you can only invest all of your money in one particular asset. And what if the other asset end up doing better? So you missed out on the better return on the other asset that you didn't invest in. So one way you can protect yourself against that sort of scenario is by take out a credit spread option. Okay, so we have one example here. So example here is that you can buy Australian bonds and you can buy Japanese bonds, right? So assume if you have $10 million to invest and you buy $10 million of Australian bonds, then what if the Japanese bond did really well, so you missed out the return on the Japanese bonds? Now let's think about what's the most important factor affecting the bond price. So one of the most important factors that's affecting the bond price is obviously the interest rate, right? So the way the relationship between the interest rate and the bond price goes like this. So if the interest rate go up, the bond price actually go down. So they work in the opposite direction. So in this example here, the risk you face is that if you bought the Australian bonds, and if the interest rate go up, then your bond would worth less, right? And on the other hand, the Japanese bonds would value much more than the Australian bond that you're currently holding. So what you can do is you can buy one of these credit spread options. So basically, if the difference between the interest rates in Australia and Japan reach a certain level, then a payment gets triggered. So you get a payment to compensate the fact that you missed out the return on the Japanese bonds. So in other words, the way the credit spread option works is that if the difference in the interest rate gets widened, then you'll be compensated with a payment. Okay? So in this example here, it actually requires a quite large difference to trigger that payment. So the question says, whenever the yield on the Japanese bond exceeds the yield on the Australian bond by 600 basis points, then you'll be compensated as the difference between the value of the Japanese bond and the Australian bond. So you'll be compensated by the market value times the 600 basis points. Right? So does that make sense? Basically, people take out credit spread options to compensate for the opportunity cost. Any question on the credit spread option? So again, you don't need to know how to value these options, but you need to be able to demonstrate in words how they work. Okay, so let's have a look at another type of derivative, which is weather derivative. So normally when people think about weather derivatives, they think about the cost of electricity, right? So if you're in the electricity business, you know that there is one type of company called retailer company, and there's another type of company called generator company. Okay? So the way how it works is that the retailer companies would sell the contracts to the customer, retailer customer, to us, right, to the household. And basically, the price they can charge from their customer doesn't change much, So the price they charge from you guys is pretty much constant throughout the time. All right? So that's the retailer company. And then the retailer company themselves, they don't generate electricities. They have to purchase electricity from the generator company. All right? But generator company, on the other hand, they can charge whatever price they want based on the market demand of electricity at the time that you bought those electricity. Okay? So now, as the retailer company, you face a type of risk, right? So you're facing the electricity price risk. Now, if the electricity price goes down, that's good for you, right? Because that just lower your cost, lower your purchasing cost. But what if the electricity price goes up? That means you have to pay more money to the generator company to purchase same amount of electricity. Okay? So in mid-90s, that's when the weather derivative came into play. Okay? So the weather derivative came into place in 1990s because California in 1990s, the state government used to own everything. But in 1990s, state government of California decided to deregulate the electricity market. Okay? So basically, in the past, the retailer company and the generator company used to be one company. They are owned by the state government. So after the deregulation, those two types of company actually separated. Right? And for the energy retailer company, the price they can charge from the customer is fixed. On the other hand, the generator company are free to charge at whatever price they wanted to charge. Basically, that price is based on the demand of electricity. So you can imagine during the peak hours, which is during the daytime, the electricity price is very expensive. And during the nighttime, nobody using electricity, the price is very cheap. Okay? And then that creates a problem. So the problem was, during the peak hours, the retailer company cannot afford to buy the electricity from the generator company because the price was so high. So that's why you had a lot of blackouts during that period. Okay? So electricity blackouts severely affects the California's economy. So what government did was to encourage the financial markets to introduce some sort of derivative product that can help retailer company to manage that sort of risk. So that's when they introduced the weather derivative. All right, so in a minute, we're going to talk about how the weather derivative actually work. In fact, weather derivative is very similar to option contract. There's just some jargon that you need to remember. So the first thing you need to understand is something called HDD, which is heating degree days. So basically, heating degree days is essentially how much electricity I need to use to provide for heating purpose. And on the other hand, we have something called CDD, which is cooling degree days. So basically, cooling degree days measures how much electricity I needed to provide for cooling. Okay? And the one thing you have to bear in mind is all of this temperature is measured in Fahrenheit, right? Because the weather derivative was introduced in the United States, and in the States, they use Fahrenheit. So the way how this option works is we have an initial value minus this capital A. So first, let me talk about this initial value. So this initial value is actually means 65 degree Fahrenheit. Now, if you translate that into Celsius, so 65 Fahrenheit is about 18 to 19 degrees of Celsius. So why this initial number matters? Because if you think about 18 or 19 Celsius, in a room, people don't really need to use the heating. They don't really need to use the cooling. All right? So that's the anchoring point. That's the starting point. Which means if you have an average degree about 65 minus 65, then you don't need any compensation for that because no one's using the electricity for heating or cooling purpose. All right? So that's the initial value, 65 Fahrenheit. So what's this capital A here? Now, this capital A actually measures the average between the highest temperature and the lowest temperature measured in one particular day, all right? So basically, over the course of day, you'll find the maximum temperature, and then you'll find a minimum temperature. They all measured in Fahrenheit. Then you'll take an average of that. All right, so let me give you one particular example here. So just imagine if the average degree that people take between the highest and the lowest temperature over a course of day turns out to be a very low number. All right, so just imagine if we take the average, and the average turns out to be 0 degree Fahrenheit. So give you some notion, 0 degree Fahrenheit is about minus 17 Celsius, which means in that day, it's very, very cold. All right? Now, then the people is going to turn on their heaters. That's when there's a high demand on the electricity. Then we have 75 minus 0. So 75 minus 0 equal to 75. All right? And then usually there is a multiplier outside of the bracket. So let's imagine if the multiplier is 50,000 US dollar. So you have 65 Fahrenheit minus 0 Fahrenheit, that equals to 65. Then 65 multiplied by $50,000, which means you can be compensated with $3.2 million compensation. Right? If you think about this, it makes sense, because if that day is really, really cold and everybody switch on their heaters, and that's where there's a high demand on the electricity, as the retailer company, you'll pay more money to purchase electricity from the generator company. If you have bought this weather derivative, then you'll be compensated with $3.2 million so that it actually helps you to lower the costs that you purchase from the generator company. Okay? Does that make sense? Now, what if the average degree turns out to be something like 75? So 65 minus 75, that's minus 10, right? Then you don't get any payoff, because essentially the payoff function is written as the higher value between the 0 and this. Now, if this is a negative value, then your payoff is 0, which means you don't get a payoff, because nobody's going to use their heater, so you don't get a payoff. That's why I said the weather derivative just works like an option contract. Okay, so let's imagine another sort of scenario here. Let's look at this cooling degree days. So basically, cooling degree day is just the opposite. Instead of having 65 minus the average, we have the average minus 65. So in other words, hotter it is, then the bigger payoff you will likely to get. Right? Because larger this capital A, that means you're going to get a larger difference between the capital A and the 65, and that is in turn multiplied by another multiplier, which is the dollar amount. Okay? So the example we have here is that imagine we have the maximum temperature measured during the day is 68 Fahrenheit, and the minimum temperature is 44, and you take an average of that, so that's 56 Fahrenheit. So 56 Fahrenheit in the cooling degree day, you don't get any payoff, and 55 substitute in this equation here, so 65 minus 56, so that's 9 degree difference. So 9 is multiplied by some multiplier, then you get a dollar payoff. Does that make sense? Does the weather derivative make sense? Sorry? Asian option. Yeah, you can think this kind of like Asian option, because we're not interested in, let me think about this. Yeah, you can think like that. Yeah. So any other question about the weather derivative? Okay, so this slide gives you an equation which is a rough calculation how you're converting the Fahrenheit to Celsius. So that's just a very rough calculation there. Okay, so we actually have a numerical example here. Let's have a look. So basically, in practice, the seller of the weather derivative, they usually specify the HDD or CDD in a cumulative term. So let me demonstrate what do I mean by cumulative term. So one example here is that in January 2004, a dealer sell a client a call option on the cumulative HDD during March of 2004 at a Washington, D.C. airport weather station with a strike price of 600 and a payment of 5,000 per degree day. Now, if the actual cumulative HDD is 700, then the payoff is this much. So let me demonstrate how this works. So basically, during the March 2004, so March, there's 31 days, right? 31 days, and each day, you go to the weather station, you take the measurements. So you measure the highest, you measure the maximum degree and the minimum degree. Then you take an average, so you get a daily average measure. So the daily capital A, okay? So that's just the capital A for one particular day. Then because you have 31 days over the course of the March, right? So what you do is you sum up all of those HDD across 31 days. Now the sum is the cumulative HDD. If the sum of the 31-day HDD turns out to be greater than 600, then you will get a payoff. And the payoff is 5,000 per degree. So basically what is going on here is people take the measurements on a daily basis, then they sum up all of the HDD over the course of 31 days, and the cumulative HDD is 700. So 700 minus 600, so that's $100. That's $100 degree more than the strike price. So the 100 multiplied by the 5,000, so that turns out to be 500,000, 500,000. So this is how weather derivative work. So usually the contract is specified in a cumulative term. Yeah? Yes. Yeah. Yes. Yeah. So basically, well, okay. So basically, the problem with this particular derivative is written over the course of a month, right? And I mean, as you mentioned, in certain days, obviously, you're not going to be compensated. So, well, the advantage with this is really cheap. It's obviously going to be cheaper than a daily contract. There is daily contract, actually. So the daily contract doesn't work on the cumulative HDD. The daily contract works on the daily HDD. Now, obviously, the daily contract is more expensive. Now, I can imagine if I'm a small retailer company, I can only afford the monthly contract. Yeah. Exactly. Yes. Yeah, I have a threshold. Yeah. Yeah, exactly. Yeah. Yeah, so with this particular contract, it's written over the month, right? So obviously, this contract is a lot cheaper compared to the daily derivative contract. So with daily ones, every day you can make a decision. Sorry, every day you have the right to entitle to a certain amount of the payoff if everybody start to use their heater. But this one is over the course of months, okay? So this contract is a lot cheaper. All right, so this slides basically talk about how people price those weather derivative contract, right? So just then, we just talk about the buyer of those weather derivative, right? We're talking about those contracts from the retailer company's point of view. What if you are an insurance company, you sell this sort of product? How do you price them? So basically, the way you can price them is by collecting a lot of HDD observation. Imagine you collect the daily HDD over past 50 years. And the example given here is that what you can do is you can run a regression, right? You can run ordinary least square regression, and you fit a line through those observations, and you get the slope from the regression, so that's your beta hat. Then you're using your beta hat to predict the HDD for the next period, right? Then you're using the predicted value to price the derivative contract. So that's roughly how it works in real life, okay? Okay, so we just talked about how the energy company use the weather derivative. Let's think about how other companies can also benefit from the weather derivative. So this is a very interesting example. Many years ago, before the internet, people purchased stuff by catalog, all right? So there's this company called LL Bean. Basically, LL Bean was really, really popular in 70s and 80s. So what LL Bean does is a clothing manufacturer. So it manufactures the winter clothing. And basically what they do is that at the beginning of the winter, the LL Bean would print in a catalog. So in the catalog is all of their newly designed winter clothes, all right? So they physically mail those catalog to the household, right? So they mail those to maybe 15 million household. And once the household receive those catalog, they flip through the catalog, and if they like the clothes, they tick, and then they mail it back to the LL Bean with some money to purchase the clothes, then they mail the clothes back. So that's how the shopping works before the internet shopping. And although this example is not that relevant nowadays, but let's talk about how other companies can utilize this. LL Bean did some research. So they realized that if the catalog arrived in the household on a warm day during the winter, then the chances are the people would pick up the catalog and they think they don't need to buy them winter clothes, so they dump the catalog in the trash bin. Okay? So then the LL Bean is facing a risk. Why? Because obviously printing the catalog costs money, and it also costs money to with the postage, right? So it costs money to post those catalogs to the household. Now, let's imagine if each catalog plus the postage costs $2, and if LL Bean is posting those to 50 million households, so that's $30 million. So that's quite a lot of expense. Now, obviously, if people receive LL Bean's catalog on a warm day, that $2 catalog is going to be wasted. So that presents a sort of like a weather risk to LL Bean. Now, to hedge that risk, what they did is they look up every single zip code or the postcode for each area, then they look at the weather forecast for those areas, and then they would buy the weather derivative for those areas that they think is likely to have an unseasonable warm winter. All right. Now, if the catalog indeed arrive on a warm day, then the LL Bean would get a payoff. So once they get that money, the company would reprint those catalog, and they would repost those catalog to the household again. And hopefully that arrives in a much colder day, and people start to buy winter clothes. So that's how other industry can be benefited from the weather derivative. This is a pretty old school example, I have to say. Yeah. Yes, so agriculture business. Agriculture business, what else? Let me think. Obviously, insurance companies. So if you're the property and casualty insurance companies, you can also benefit from the weather derivative, right? Because I think what happens this year is there's wildfire in California, right? So that's when the damage claim start to rise from the property and casualty insurance claims. So that's when the insurance company can also benefit from the weather derivative. Yeah. Yeah, tourist company. So the tourist company, imagine if if the tourist company is based in Canada, if people wanted to go to Canada for the winter tourism, and if there's a very warm winter, then the tourist company can take out weather derivative to protect against a shortfall in the tourists. Yeah, very good examples. Yeah, so basically the weather derivative can be used in a lot of industries. We just give 2 examples here. Any other question about the weather derivative before we move on? All right, so the more direct derivative is obviously the energy derivatives. Okay, so at the moment, the main method that we provide energy in Australia is by burning coal, right? So only 4% of Australians' energy is generated from renewable energy. Actually, we're burning a lot of coal, and we use a lot of natural gas and petrol. Okay, so energy company obviously face the risk when the price of that energy goes up. Okay, so in Australia, Australia used to have some of the cheapest natural gas price in the world because we have some of the largest deposit of natural gas. But about 10 years ago, we started to exporting the natural gas overseas. So now the price isn't set in the domestic market. The price of the natural gas is set internationally. So that's why you see the natural gas price increased tenfold in Australia. And then with the electricity price, so the spot market of the electricity is very volatile. So you see the huge price fluctuations over a course of a day. So within a day, the electricity price can change by 1,000%, right? 1,000%. So at one point in the day, it can cost you 10 cents per kilojoule, but in another point in the day when everybody start to use their heater, or maybe everybody start to use their air conditioning, then it can cost you $2 per kilojoule, all right? So it's crazy. There's huge fluctuation in the energy price throughout the day. So now you can see there's a purpose for this energy derivative to manage that sort of risk. Okay, so the first one we're going to look at is crude oil. So the total crude oil consumption around the globe every day is about 80 to 90 million barrels of crude oil each day. Right, it's used for a lot of stuff, used for passenger cars and used for making plastics. And so there's a high demand for oil, and oil price is very volatile. And one of the reasons why the oil price is very volatile is actually political reason. So if you think back to 70s, when the global economy is really dependent on oil, we actually had oil crisis, right? So the oil crisis happened when the members of OPEC countries stopped exporting oil. So those countries located in the Middle East. And at the time, the oil price went up, increased by 300 to 400%. And it actually caused some minor recession in Western countries. Okay, so that's when the Western countries start to diversify away from the oil for providing the energy needs. So nowadays, we have energy source coming from natural gas, nuclear energy, and obviously renewable energy. So if there's another oil crisis take place nowadays, it probably wouldn't have much of an impact as it did back in the 70s. Okay, so what can you do in terms of using the energy derivative to hedging the energy price risk? So first of all, we have the over-the-counter contract, for example, the forward contract. It's just a very standard forward contract, as we learned back in week 2. It's just a forward contract that's written on crude oil, right? So basically, it can take form of cash settlements or physical settlements. Then we also have some exchange-traded derivative contracts, for example, futures and future options. And one of the biggest exchange is New York Mercantile Exchange. So that's where the futures option get traded. Remember, as I mentioned, futures option is a very liquid instrument. It's way more liquid than the spot option. And 99% of the settlement is cash settlement. So natural gas. Let's talk about. So basically what happens with the natural gas is in 60s, Scotland discovered there's this huge natural gas deposit in its North Sea. Okay, so North Sea is the area near the Scotland, and that's where they started this mass use of natural gas. All right, so the mass use of the natural gas extended to 70s, which coincided with the oil crisis. So that's when the Western country tried to diversify away from the oil as the main energy source provider. So because that's where the mass production of the natural gas is. So the natural gas is measured in British thermal units, okay? So in the natural gas derivative contract, you would say that most of them is measured in the British thermal units. Okay, so electricity, as we mentioned before, the demand is not constant. So the biggest demand period for the electricity is actually during the day, right? And during the night is off-peak hours. So electricity usage has this huge fluctuation, as I mentioned earlier. When the heat wave hits the country, that can increase the spot price as much as 1,000% in a very short period of time over a course of day. Okay, so how do this energy contract looks like? So a typical contract specifies number of megawatts hours for a specified price, for a specified time, and for a specified location. For example, you can have this off-peak hour derivative. So this is mainly used for the nighttime when people don't use as much energy. So the way you interpret this 5/8 contract is that this is the 8 hours off-peak from 11 p.m. to 7 a.m. in the morning. And 5 simply means that's 5 days in a week, from Monday to Friday. And then we have our peak hour contract, which is written as this, 5 times 16, okay? So 5 times 16 is your peak hour derivative from 7 a.m. to 11 p.m., 5 days in a week. And then you would have as I mentioned before, you would have the daily contract and the monthly contract. So with the daily contract, the option holder can make a decision at the beginning of each day whether or not I want to buy a certain amount of energy, certain megawatts of electricity for a specified price for that particular day. Okay? So each day you can make up your mind. Basically, the daily contract is very useful because nowadays the weather forecast is quite accurate. You can just look up the weather forecast and think about whether you need that option. And then we have the monthly exercise energy derivative. Basically, the way it works is that at the beginning of each month, you ask yourself, do I need to access this option contract? Do I want to buy a certain amount of electricity for this specified strike price? And with the monthly excess option, you have less flexibility. So you would expect the monthly contract will be selling at a much lower price compared to the daily energy derivative contract. All right, I think this is a good time, which we'll take a 5-minute break, and we're going to go back, talk about the cat bonds, and then we're going to talk about some interesting derivative market mishap. Okay, so 5 minutes break. We'll be back in 5 minutes. Okay, guys, so let's resume the lecture. All right, so another type of derivative contract we're going to talk about is insurance derivatives. Okay, so if you think about insurance service, how it works is that imagine you take out a home insurance policy on your house, let's say with Westpac, and basically you pay a certain amount of premium on that insurance policy, and that insurance policy could probably insure up to 800,000 or 900,000 worth of value, worth of the building and the contents. And most of those banks who sold you those insurance policies, they don't actually bear the risk. Okay, so once they insure for you, they would immediately sell that to a global major insurance company, and those big insurance companies would bear risk for them. So this is called reinsurance. So that's the traditional way of how reinsurance works. So today we're going to talk about an unconventional way of how the reinsurance can also be working. So, okay, so this is one example I talk about the traditional way of reinsurance. So imagine the bank has exposure to 200 million to the potential earthquake in Newcastle. The bank wants to limit its exposure to 50 million. Then it would get into a reinsurance contract on 75% of exposure. In other words, the company would sell 75% of its insurance policies to another reinsurance company. Now, if the earthquake indeed happened and caused a damage claim about 100 million, then the reinsurance company would pay 75% to the client of the insurance policy holder. Okay, so that's traditionally how reinsurance works. Now, the alternative way how reinsurance can also work is for insurance company to issue this catastrophic bond. Okay, so short for cat bond. Okay, so insurance company can issue this cat bond, and this cat bond would work just like your normal ordinary bond. The difference is that this cat bond would pay higher than normal interest payment to the bondholder. So why is paying a higher than normal interest payment? Because this is for exchange. So basically, this extra interest payment is to exchange the agreement of the bondholder, agreement on providing excessive loss of reinsurance contract. So let me elaborate how this works. So it depends on the term and the conditions on the issuance of the cat bonds. The interest and the principal of the cat bond can be used to meet the damage claims from either the earthquake or hurricane. So for example, if there's an insurance company that wanted to protect for California earthquake, they wanted to be protected for the loss between 30 million to 40 million, then the insurance company could issue a cat bond with a total principal of 10 million. So in the event the insurance company's California earthquake loss exceeds 30 million, then the bondholder would lose all of their principal, and then the insurance company can use that money to meet the damage claim. Okay, so basically, in other words, instead of selling those insurance premiums to another reinsurance company, the bondholders contribute their interest payment and the principal to meet those excessive damage claim. So that's another way how the reinsurance can work through the cat bond. Then you would ask why people would still willing to buy the cat bonds if you're going to lose all of your principal and interest upon a disaster such as earthquake. Well, because the reason why people buying the cat bond is because the chance of having a major earthquake is very small. All right, so that probability is very small. So in other words, you can still get a pretty good return from the coupon and the principal from the cat bond. And another major reason why people buy in the cat bond is, remember, going back to your Finance 101, when you learned about the concept of diversification, you have seen this graph, right? So basically, what this graph tells you, so on the y-axis, you have the total portfolio risk, so that's sigma squared. And on the x-axis, you have number of risky assets, right? Now, as you put in more and more different types of risky assets in your portfolio, you see this total portfolio risk actually reduces, right? So that would shrink to the point where there is only systematic risk left, okay? Right? So the systematic risk in your portfolio represents the average correlation among all of the risky assets you hold. So you can diversify to a point where you cannot push this systematic risk further. So why putting more and more assets in your portfolio can reduce the total risk? Well, because having the risky assets with different return correlations, the good event and the bad event on average would cancel out. So that's why you can reduce the firm-specific risk or asset-specific risk. So those are called diversifiable risk. However, if you think about the risky asset in the world, more or less they would have certain amount of correlations, right? So that's why when we push to the point, when we're adding 30 or 40 risky assets, there will always be this systematic risk that cannot be diversified away. So it's also known as the non-diversifiable risk. Now, in that situation, if you're already holding a well-diversified portfolio, you wish you can obtain a sort of risky assets, its correlation has nothing to do with the financial markets. That's where the cat bond came into play, because the occurrence of the earthquake or hurricane has nothing to do with the financial market performance, right? So in other words, their correlation should be zero. So by adding the cat bonds with zero correlation with the market portfolio, you can shrink this systematic risk even further, right? You can push down this systematic risk to a much smaller amount. So the main reason the people buying the cat bonds is because of that diversification benefit. Does it make sense? Okay, so we covered all of the other types of derivative today. Then for the second half of the lecture, we're going to talk about the mishap in derivative instruments. So the first example we're going to talk about today is the Barron Bank and the Nick Leeson. Okay? So this is a good example where the short straddle strategy has gone wrong. So it's a good quick recap to recap what the short straddle strategy looked like. Basically, with the short straddle, remember, when we did this in week 4, what we did is we short in a call option and we short in a put option, right? Now, we short a call, we short a put, and those option has the identical strike price. Now, once you set it up, you have a payoff function look like A shape, right? Look like this. So basically, with the short straddle, you hope for stability, which means you hope that the stock price would hang around that $9.75 region, right? That would not move much. Now, if the share price becomes really, really high on this right-hand side, you lose a lot of money on the right-hand side, right? Now, when the share price becomes really, really low, you also lose a lot of money, right? Because you're losing money from the short put, you're losing money from the short call. And the danger is the underlying assets, there's no upper limit as to how much the underlying asset price can increase to. In other words, you have this unlimited downside risk with short straddle. Okay, so our story begins with this bank, which no longer exists today. It's called Barron Bank. So when you read textbook case of derivative disaster, Barron Bank is up there. It's on the top of the list. Okay, so Barron Bank dates back to 1762, and that's the founder and the co-founder of the Barron Bank in the picture there. All right, so in the mid-1990s, the Barron Bank was actually the second oldest bank in the world. All right, and in early 1990s, the Barron Bank had a trader. So today we call this type of trader rogue trader. Okay. So we have this trader called Nick Leeson. So to cut long story short, this guy, Nick Leeson, he sent the entire bank bankrupt. Okay? So this picture shows Nick Leeson is trading the derivative contract. Actually, one interesting fact is that this yellow and black strip jacket recently has been traded on eBay for an auction. And people paid tens and thousands of dollars to buy this hideous-looking yellow-black jacket. All right? So what this guy did, he lost $1.3 billion in 1995. So you must be thinking, what's the big deal about $1.3 billion? Well, $1.3 billion is a big number back in mid-90s, even a big number in today's standard. Okay, so the problem of Nick Leeson is that he set up a straddle. A straddle looked just like this. Okay, so he set up this short straddle, an A-shaped pattern, right? So in this strategy, we understand we want stability. We don't want the underlying asset price move too much. If it moves too much, we lose money, right? So this guy, Nick Leeson, he set up this short straddle on Nikkei index. So Nikkei index is the main stock index in Japanese stock market. So he short a call and he short a put on Nikkei 225. And then he hoped that the Nikkei index would be stable and don't move much. Okay? And Nick Leeson had been the star trader of Barron Bank. So basically, Nick Leeson was the #1 guy for Barron Bank back then. All right, so give you a bit of a notion. So in 1992, Nick Leeson himself alone, he made bank $10 million profit. Sorry, 10 million pounds of profit, British pound. So that's 10% of the whole bank's profit. Right? It's shocking in the sense that 10% of entire bank's profit coming from one guy. Okay, so Nick Leeson was making big money back then. So his base salary was £50,000, and in that particular year, he took a bonus of $130,000, which is a lot of money back then. So he's the rock star in the Barron Bank. Now, Nick Leeson's job, his original job, is to do arbitrage. So we learned about arbitrage. So basically, the arbitrage is to identify mispriced security, then you set up long-short positions to make small amount of riskless profit, right? So he's supposed to identifying the mispriced security and then just making some small profit. That's what he's supposed to do. And you would expect the money that he earned from the arbitrage would be really small, right? Because it's basically money for nothing. Arbitrage has no risk. And that's basically what he's telling his boss what he was doing. He was arbitraging. He was identifying what kind of option is violating the lower bounds and lower bound and upper bound, and he would just set up the table portfolio as what we did to arbitrage away those money. And his boss actually believed that he's really good at identifying those mispriced security and making 10 million pounds a year for the bank. So after this whole event came into light, it turns out he wasn't arbitraging. He wasn't arbitraging at all. He was taking these huge speculative positions. And to be honest, I don't believe that his boss don't know what he was doing. I'm sure his boss was aware of what he was doing. But as long as Nick was making money for the bank, his boss was happy, right? Okay, so what Nick Leeson did back then is he was effectively gambling on the direction of Japanese stock market. And he had control of what we called front office as well as the back office. Okay, so what front office is supposed to do is doing all the tradings, all right? So front office is for traders to enter long-short positions. And the back office is for bookkeeping, right? Keep the record of what trader did. And bookkeeping plus monitoring whether they are doing some risky positions, right? And regrettably, Nick Leeson had both front office and the back office, okay? So on the one hand, he was entering the long-short positions. On the other hand, he was changing the bookkeeping, so he tried to cover up his tracks. And after his scandal actually changed the entire changed the entire industry. All right, so nowadays, there is a very strict separation of front office and back office. So basically, people who did trading are not allowed for record keeping, and people who are for the bookkeeping purpose are not allowed to trade. So this just try to preventing another type of Nick Leeson disaster. All right, so in mid-January 1995, Nick Leeson set up a short straddle. Okay, so remember, short straddle needs stability on the Japanese stock market. And he was betting that the Japanese market will not move much during that period. But unfortunately for Nick Leeson, there was an earthquake in Japan. And he didn't see that coming, okay? So huge, famous Kobe earthquake. You can still see video online. The building was falling down. And that huge earthquake had a massive impact on Japanese stock market. So Nick Leeson wants stability, and he shorted straddle, but the Nikkei actually fell from 19,000 to 17,000, and he was losing severely, okay? So in total, he lost 68 million pounds in that short straddle, thanks to the earthquake. But Nick Leeson, he didn't want to say sorry. He didn't want to say sorry to his boss, you know? He didn't want to say, I've been lying to you all these years. I wasn't arbitraging, I was gambling. So he didn't want to tell his boss the truth, so what he did is he tried to cover it up. All right, so what he did is that he bet the market would rebound short after the earthquake, because the earthquake was short-lived, right? And he thought that, you know, there's nothing wrong with Japanese economy, so the earthquake should recover short afterwards. Then he entered into some massive long futures position. Remember, for the long future to work, you need an upward sloping line, right? So you need the market to increase for him to make money on those long futures position. And here is a graph of Nikkei 225 during 1995. So if you look at this picture, so this is where the earthquake happens, right? So that was a sharp decline. And then for a short while, his long futures position actually worked. So the market actually rebounded after the earthquake. So he was making a bit of money on his short futures contract, but that was short-lived, right? We see that market plummeted even further. Okay, so basically he blew up on his long futures position, and he got killed on the short straddle first. Now he got killed on his long futures contract. Now it turns out he lost 1.3 billion on those long futures contract. And then he did what we all will do if we did that, which is to run away, okay? So that's Nick Leeson, he ran away. So he fled to Singapore, then he went from Singapore to Malaysia, to Thailand. Eventually he got caught in Germany. All right, so that's where the police got him back to Singapore, where he was convicted, all right? So people tried to save the Barron Bank, but they couldn't. So basically, Barron Bank went bankrupt, thanks to Nick Leeson. So he was charged with fraud, deceiving his supervisor. I reckon his boss knew what he was doing, as long as he was making money for the bank, right? And basically, he spent only 3.5 years in the jail, and he developed some cancer while he was in jail. So they let him out early. So after Nick Leeson out of the jail, of course, he wrote a book. So the book title is The Rogue Trader. That's him. And then obviously we have a movie about him. So this is the movie, Rogue Trader. And then he wrote another book called Coping with the Stress. So obviously, surely he knows how to cope with stress. And now he become a manager of the football club. Now he lives in Ireland. So what he do nowadays, he just gave public speech to people of what he did back then. So he's making some decent money giving public speech. All right, so that was him on the Time magazine. So the Time magazine says ego and greed, right? So that's what he looked like nowadays. So this is a sad story, okay? So what I was trying to remind you is, with the final exam fast approaching, the lesson of Nick Leeson is that he should have paid more attention to short straddle strategy when he did Finland 2002 or Finland SEM041, right? So that's one of the most famous derivative mishap. Okay, so what lesson we should learn from those derivative mishap? First, you need to define the risk limit. So actually, this and stress test goes together. So nowadays, most of banks run value of the risk, right? So basically, value of the risk measures the risk of loss for the investments. So the estimate how much a set of investment might lose given a probability. So for example, if a portfolio of stock has one day 5% value of the risk of $1 million, the way you interpret that is 5% probability the portfolio would fall in value by more than $1 million over a course of day. So people run stress tests, then they would define their risk limit properly. And another suggestion is don't think you can outguess the market, right? So the lesson we learned from Nick Leeson was after he lost 68 million on the short straddle, he shouldn't be entering into those long futures contracts because he thinks he can outguess the market, right? So that was one of the biggest mistakes. And diversify, right? So if you look the Nick Leeson track record carefully, you realize he liked to put all of the money in one single strategy. For example, either short straddle or one single strategy with long futures contract. It's very, very risky to do that, right? You need to diversify with multiple strategies. So another lesson learned is to diversify. Okay, so more lesson to be learned. Monitor the trader carefully. Have a clear separation between the front desk and the back desk, right? So Nick Leeson had both front office and back office. Now we have a very strict, clear separation. Don't blindly trust the models, okay? So remember when we learned all those option pricing models, we made a lot of assumptions, so obviously the model wasn't always that accurate. Okay, so be conservative and don't sell the client with inappropriate products. So basically, there was this news I read last year. So basically, I think ABC, so Australian Broadcast, went onto the street and interviewed people, said, how much idle cash do you have? So how much cash you're sitting in a bank account? So they just go onto the street and ask average people like us. So the answer they got is, on average, people have roughly around 20,000 Australian dollar cash in their saving accounts. And then the journalist said, why don't you invest those money? Why you just let those cash sitting idle? And then the most answer people gave to the journalist was that they don't trust their financial planners, right? So they had the feeling that the financial planner would rip them off. Okay, so basically, financial planner would just recommend the products which earn the highest commission for themselves rather than for the benefit of their clients. So obviously in Australia, we have this trust issue going on, right? So that's what preventing people to invest more money into the equity market. So in other words, we shouldn't be selling our clients the products that would earn us the most commission. Rather, we need to sell the product that they actually need, okay? And another lesson we learned is do not ignore liquidity risk. So people keep telling me that, Mas, if you look at today's liquidity, especially when the algo trading, so algo trading and robotic trading is so popular in the Wall Street, why you worry about liquidity, right? So any day you can sell a large amount of shares in no time, just like this, with very little cost. But I wanted to tell you guys, liquidity is actually quite misleading because on a normal day, a stock appears to be very liquid. You can buy and sell a large amount of shares for very little transaction cost. But when you need the liquidity the most, which is during a black swan event, during the financial crisis, everybody is entering in the selling order, all right? Algo trading actually made it worse because algo trading just follows what everybody else is doing, selling their portfolio. So you can imagine the market is cramped with all the sell order and no buy order to provide for the liquidity. So when you need the liquidity most, liquidity is not there. So don't overestimate the amount of liquidity on the asset that you're currently holding in your portfolio. Don't follow the herd, right? So don't try to do what everybody else is doing. Don't finance the long-term project with the short-term debt. If you have a 30-year long-term project, don't take out a 1-year loan, then roll over each year. It's very risky, right? Because every year you're facing interest rate uncertainty, and it's not guaranteed that you will always get another 1-year loan. So if you want to finance a 30-year project, please take out a 30-year debt. So be transparent. So disclose everything to your supervisor. Disclose all the trades that you entered. Manage incentive. So we'll talk about this. We can manage the manager's incentive using the forward start option, right? So give them an employee stock option, and never ignore risk management, right? So risk management tools such as value the risk I mentioned earlier. Okay, here are just more recommendations for the non-financial corporations, which is quite similar as what we talked about before. So one thing I want to emphasize is that don't try to make your treasury department into a profit center. So for instance, if you are an oil company, your main business is by producing and selling the oils, right? Now, having the derivative in place is to help you manage that risk. Don't try to think you can outguess the market, right? So a lot of oil companies, what they did is they betting the direction of the oil price by using the futures contract. So that's a typical example of turning their treasury department into a profit center, okay? So hedging is not their main business. You shouldn't turn hedging into speculation, okay? So code of ethics. I've actually got a one-page cheat sheet on the Whortle. So if you log on to your Whortle, go to the Wiki 11. So there is this cheat sheet here. Basically, that just details. So it's not available to you guys yet. It will be available on 19th of May. So that would become available to you guys. So basically, that's everything you need to know about Code of Ethics. All right. So I just summarized the Code of Ethics to you guys in that one-page summary. So that's all you need to know about the Code of Ethics. Now let's just have a look another two quick example. Then we're pretty much done. Okay, so the first thing I want to talk about is the classification of information. So we actually classify information into different types. So the first type of information we have is called material information. So which page? Yeah. So the first one is called material information. Okay, so material information is the insider information, if you like. It's the information that can affect the stock price. So for example, if one company is thinking about take over another company, right? So probably only few top executives in that company knows about this deal, and probably the investment bank who is advising on this deal knows about this information. And this information is material in the sense that once it gets leaked out, that would affect the price of the target firm, right? Because in corporate finance, you learned that when you try to take over another company, usually there is a premium associated with the takeover bid, right? So let's say a 20% premium. So once the announcement is made, the share price of the target firm can increase like 20% in a day, right? So if anybody traded before that, they will be benefit from a share price increase. So that's called material information, right? Material in a sense affect the share price. And then we have something called non-public information, right? So non-public information such as the financial reports, everybody can get access to, and everybody can gather information from those, non-public information. So for example, non-public information, for example, the CEO plan to retire, right? So one important CEO, they try to retire, and that's non-public information, not known to the public. And it may or may not have a material impact on the share price. But still, that should not be released to the public. And then we have something called mosaic theory. I'll talk about this with one example. Then we have investment research report. So that's the report produced by investment bank and analyst. So those information are fine. So if you purchase the report from the analyst, you can trade on it. That's perfectly fine. That's how industry works. Because most likely, the analyst is gathering the public information and producing the recommendation report, so you can form your buy, sell, hold decision based on the research report. So basically, you shouldn't be trading on the non-public material information. Because if you're doing that, that's insider trading, right? So in Australia, you go to jail for that. You shouldn't be trading on the material non-public information. Okay, so let me give you one small example about mosaic theory. Okay, so just imagine you are an investor which is paying a lot of attention to the insurance company industry. So basically, you specialize in analyzing the insurance firms, okay? So based on your extensive research from the public information, you think that the QB insurance company is going to merge with the Medibank, okay? So that's all of the public information. And you get the conclusion based on your feelings, okay? And then one day you walk on the street of Melbourne and you walk in a coffee shop, you recognize that the CEO of the QBE is having a conversation with the CEO with the Medibank. Now, that's all you have seen. Then you made a conclusion, think that, okay, the merger is definitely going to happen. Can you trade on that conclusion? Yes, you can, because you get that information from the public information and some part of your information, for example, spotting the CEO of the two companies having a coffee conversation in the public space, that's non-material, non-public information. Well, you can trade on that conclusion. It's not illegal to do that because basically you piece together all the information from the public source and non-material, non-public source, okay? Does that make sense to you guys? Basically, in that circumstance, there's no insider information involved, right? Although two CEO having a coffee conversation is not known to the public, but it's also non-material. So if you can piece together that conclusion and you trade on it, you benefit from that trade, it's not illegal to do so. Okay, so that's the investment bank research report. Let's have a look at two examples here, okay? So the first example says Frank. Frank is the president and the controlling shareholder of Smart Town Clothing. And Frank decides to accept the tender offer and sell the family business at a price that's almost double the market price of his current share price. And what he did is he described the decision to his sister, so Smart Town Treasurer, who is conveys it to her daughter, who owns no share in the family company at the present, okay? But then her daughter, which in turn tells her husband, Staple, okay? Then Staple in turn tells his stockbroker, Alex. Then the stockbroker immediately bought some share for himself. So is there any violation there? Let's think about this. So first of all, Frank tells that information to his sister. And his sister worked as a treasurer in Smart Town. Well, I think that's probably okay, because if you're the treasurer of Smart Town, you are one of the top executives, right? So with that sort of information, I think top executive can get access to, right? So up to that point, everything seems fine. But then the treasurer tells to her daughter, all right? Then the daughter tells to her husband, Staple. But Staple himself did not buy shares. So Staple himself did not benefit from this. But then what Staple shouldn't be doing is telling his stockbroker, right? Because we all know what stockbroker do, because stockbroker just give advice to their clients in terms of what stock to buy, what stock not to buy. So obviously, if you tell that information to the stockbroker, that information will be leaked out, right? So that's something that Staple shouldn't be doing. And obviously, Alex is trading on those material information, right? He bought some share for himself. So Alex is definitely violating the standard, all right? So here's the comments, the conclusion. So Staple has violated the standard by communicating this inside information to his broker. He shouldn't be doing that, right? So he owns the duty of care to the company because you should foresee that the stockbroker is likely to leak that information to the public. So he shouldn't be doing that. And Alex certainly violates the standard by buying shares on this material information, right? So he conducted the trading on the material information. So there's a clear violation with Alex. Okay, here's another example. Leah is trying to decide whether to hold or sell shares of an oil and gas exploration company that she owns in several of the funds that she manages. Although the company has underperformed the index for some time already, the trends in the industry sector signal that the companies of this type might become takeover targets. While she's considering her decision, her doctor, who casually follows the market, mentions that she should think the company in question will soon be bought out by a large multinational conglomerate. And that would be a good idea to buy the stock right now. So after talking to various investment professions and checking their opinions on the company, as well as checking the industry trends, Leah decides the next day to accumulate more share on the oil and gas exploration. So is this okay? So let's think about this. So Leah got this idea from her doctor, right? So obviously her doctor just casually follows the stock market. So doctor probably don't have any material inside information, so that's fine. And she just talked to the professional in the industry, and anybody can talk to the professional in the industry. That's public information, so that's probably fine too. So in other words, those information cannot be considered to be material, right? In other words, Leah is not prohibited from trading the stock on the basis of those information. Okay, so one last example. Let's have a look at another example here. So the one last example says, the principal owner of financial information service, FIS, entered into agreement with two microcap companies to promote the company's stock in exchange for stock and a cash compensation. And the principal owner caused FIS to disseminate email, design, and maintain several internet sites, and distribute an online investment newsletter, of which recommended investment in the two companies. So the systematic publication of independent analysis and recommendation contains inaccurate and highly promotional and highly speculative statements, which increased the public investment in those companies and led to dramatic higher stock price. So basically, the owner of the FIS violates the standard, because what owner of the FIS is doing here is manipulating the market, right? So the FIS is manipulating the market opinion by disseminating the false information. Those information has no factual grounds and highly promotional and highly speculative, right? And the FIS is doing so by pumping up the stock price, okay? So this is the typical pumping and dumping scheme. So once the FIS pumping up the stock price, and in a later stage, most likely, who accumulated the share earlier would dump those shares at a high price, all right? So for those investors who read into those misleading informations, actually that would cause a loss for them, right? So the comment says, the owner of the FIS violates by disseminating misleading information to misguide other investors. Okay, and those two companies also violates the standard because basically those two companies is paying the FIS to do so, to disseminating the false information. Okay, so that's all for today's lecture. So the only thing you need to know from the code of ethics is from that one-page sheet that would become available to you guys this Friday. And also my consultation for today, so my consultation is usually on Monday, right, is changed to Thursday, okay? And we don't have Monday's lecture next week, we have lecture on Thursday. I'll make an announcement about that on Woto. Thank you, everyone. Sorry? I haven't finished writing the final exam. I'll think about it. I'll let you guys know next week, okay? You guys can ask me questions during next week's revision lecture. See ya, guys.